Hello, everyone. Hope you're doing well. Are we in a debt collapse? And how's the bond market doing? Time for a charting update. And let me just move this title card across so we can have a look at some charts. And the first thing I wanted to show is, a lot of the gurus online are calling for a debt collapse. I think the debt collapse has essentially already happened, and we're just sort of trending sideways as we have been for the last 3 years or so. But let's firstly look at some evidence that we are in a debt collapse. And one of the things that they would correctly point to, the first time the Federal Reserve cut interest rates was in this cycle was September 18th last year, 2024. We can see the Federal Reserve cut from an upper bound of 5.5%. They did a 0.5% rate cut, went down to 5% or 4.75% on the lower end of their range. And here we're looking at a US 1 month bond. So T-bills, 1 month being the shortest term interest rate, a 4-week bond essentially. And you can this one is a lot of the gurus are telling you that the Federal Reserve or that central banks don't control interest rates, and it's a much more complicated conversation than that. They certainly control short-term interest rates. They can control long-term interest rates, in my opinion, if they choose to, but right now they're not choosing to. They're not doing QE programs. They're not buying bonds. In fact, the Federal Reserve has been selling bonds or letting bonds mature. But one of the things that the we're in a debt collapse gurus would correctly point to is if we do a comparison of the 10-year yield on this chart, so the 10-year interest rate, you can see that sorry, my chart skipped a bit when I added that. On the 18th of September, when the Federal Reserve enacted that 0.5% rate cut, we saw the 1 month bond rate fall. But look at what happened to the yield or the interest rate on 10-year US government bonds. It went from about 3.63% up to 4.82%. So as the Federal Reserve was cutting rates, the longer term interest rate went up about 1.2%. Now that's very concerning. It should be concerning for the US government that has massive, massive debt. And it's certainly something that the we're in a debt collapse gurus can point to, and I would agree with them on this one that this is a bit of a problem. So you can see that divergence there. But what we might do is we won't look too much at short-term interest rates today because central banks, including the European Central Bank, just did their 10th interest rate cut the other day, just to finish up the week. So central banks are cutting short-term interest rates, but they're losing control of long-term interest rates. But let's just have a look at how potentially bad it is. And we're looking at a 1-year chart of this is the 10-year interest rate, which is a key interest rate on US government debt. I've switched to a 5-year chart, and I've shown these before, but you can see in October 2023, there was a peak, and we're in this sort of rising channel, which we've seen before. We saw negative divergence forming on the momentum indicators. So as the price was making higher highs, the momentum indicators were making lower highs, indicating that the uptrend in interest rates, keeping in mind that the price of bonds, so if you're an investor, if you're buying bonds, interest rates and bond prices move in the opposite direction. So if interest rates are going up, bond prices are going down, you're losing money on your investment if you're invested in bonds. And of course, if interest rates are flattening out or coming down, that means you're going to earn some capital growth in bonds if that in fact does happen. Keep in mind, not investment advice in this video, just talking to you about my thesis from a charting perspective and what I'm doing for clients and how I'm managing money for clients. But we can see this rising wedge pattern. That's a bearish pattern. You can see the breakdown, classic textbook case, return to the scene of the crime. And so we established a high there. Note that that high is holding so far. It held again in January this year, and we haven't come up to test it yet. So, I mean, this looks to me like, through 2020, we were in an uptrend, massive uptrend. That's your bond collapse. Because remember, if interest rates are going from, well, this is the 10-year, if interest rates are going from under 1% up to nearly 5% or touching 5%, that is your debt collapse. That is bond prices crashing. Interest rates skyrocketing, bond prices crashing. So if we clear the face there, we can see debt collapse, debt collapse, debt collapse, and then 2023 comes around, and what are we doing? It looks like we're topping out and potentially getting ready to roll over. Now, I could be incorrect about that. Maybe we are going to bust through there. That would be a 45-minute conversation about all sorts of, we can see what happened last night. So Trump has met with Federal Reserve Chairman Jerome Powell, and he's pressuring him to cut interest rates, not by 0.25% as central banks normally cut rates, but he wants a full percentage point. President Donald Trump urged Federal Reserve Chairman Jerome Powell to slash interest rates by a full percentage point. That's because he needs this rate to come down. He needs bond prices to go up, and he needs interest rates to come down, as do many governments. Governments are accumulating debt exponentially. They're going bankrupt. They can't afford the interest payments on their debt. The US federal government over the next 12 months or so, or at least through 2025, has between $7 to $9 trillion of debt it needs to roll over. So in addition to borrowing, continuing to borrow more money, they have old debt that's due, needs to be reborrowed. This is more of a charting video, so we won't so much go into philosophy about, why at some point, the Federal Reserve is probably going to have to restart a QE program. They're going to have to buy these bonds because they need to push up the price of bonds and push down interest rates to solve this problem. Let me just double check that. Just had a little glitch there that we're recording. Yep, that's fine. So let's now have a look at, just to change things up, let's have a look at what's going on in China. So China is going through, depending on which gurus you want to listen to, they're going through what the gurus would describe as a recession or depression. I don't know enough about what's going on in the Chinese economy to really comment, but I think it's probably overstated. But this is what happens when you go into a bit of a deflation scenario. You see the interest rate on 10-year Chinese government debt has fallen from 3.4% to 1.69%. It opens up a larger conversation. Like, ask yourself, what's going on with America and China? Like, we're hearing all about how tough America is and the trade war and all this sort of stuff. Why is it that the Chinese government can borrow money for 10 years at 1.7% interest and the US government has to pay 4.5%? Sounds to me like at least some people who manage money think that China's a safer bet, but that's not what I'm suggesting. I'm just showing you what can happen. Those of you who are out there calling for, a lot of the debt collapse gurus also think we're going into a global recession or a depression. Well, what can happen is interest rates come down in that environment, interest rates on government bonds. So let's have a look at the 20-year US rate, and we see again a similar thing. I probably shouldn't just keep drawing the same chart over and over again, but you can see that breakdown again, return to test, and we haven't made a new high in yields, which means we haven't made a new low in bonds. And if we look at the 30-year, you could say, and again, I'm looking at a weekly chart here, so I'm looking back to 2021. You can see it was in an uptrend. Same thing again, rising wedge, that's a bearish pattern. That pattern there is a bearish pattern. You can see negative divergence on the momentum indicators, which signaled that the uptrend in interest rates was coming to an end. Negative divergence, so interest rates were a sell, which means bonds were a buy at that point in 2023. And I've said this in many videos over the last couple of years. I think that was the historic low for bonds. Now, the 30-year is under a little bit of pressure, but note it hasn't made a new high yet. What's it doing? It's forming another little rising sort of channel there. So far, this level is held. But that chart looks a little bit indecisive. If we go to a 1-year chart, we can see rising wedge, and depending on how you want to draw it, you could draw it there like that, or you could draw it from there. I don't necessarily like that draw as much, but either way you decide to draw it, rising wedge pattern, and we've had a little bit of a breakdown, right? It's probably going to come back to test, and that's what I would say would be the most likely outcome. Keeping in mind, if this is happening, that means bond prices are going up. So I think, again, even on the short-term and longer-term charts, these levels are still, they're still holding. Now, it did break above the previous high from January, but you can see it was what you would call, let me just clean that up a bit. We draw that across there. You can see that was a key to the 5%, not only a level on the chart, but also a key psychological price barrier, the 5% level. You can see it was a high there, high there. How to go at getting above it? Now, you might want to say, okay, well, it's broken above it and it's going to do this. Yes, that's a possibility, but these levels are pretty key. And if we look at the actual price of bonds, and the best way to look at 20 and 30-year bond prices is to look at TLT, which is a 20 and 30-year US government bond fund. I believe it's the biggest bond fund, although someone correct me on that. There are many bond funds listed on the US market, and I don't have them all categorized in my head. But as far as 20 and 30-year bonds go, this is one to look at. If we look at a 5-year chart, we can see, I talked earlier about the collapse. You could see that from the high, now that was a spike high, so I'll take these highs there from 2020. Remember what was happening in 2020? Central banks were printing trillions of dollars to buy up bonds so they can push down interest rates. That's the mechanism by which they do that. And you can see bond prices fell to the low in 2023, but 51% decline, so a pretty horrible decline. But again, you can see This was the debt collapse. This was the debt collapse. Now we're in 2023. Look at what we've been doing for the last 18 months, or even you could say since October 2022, so 2.5 years ago. We've essentially just been going sideways. It's not, so all these, the gurus could still be correct. We could still have, this could just be setting up for the next leg down. I don't see that as a high probability, although I do acknowledge we could make a new low. But the debt collapse has, in my opinion, it's happened. And what we're starting to see now is, you can see that level's holding. And if we zoom to a 1-year chart, we can again see that, there's a little bit of a base here around this 85 level, briefly snuck below. And that chart doesn't look particularly bullish at the moment. But you can see this is a very key low. This is I would say, a historic low for long-term US bonds. And that level is yet to break. Even if it does trade below that level, I would say that on a relative basis, look around at other asset classes and how expensive, like stocks almost back to record highs, gold at or near record highs, silver pumping in price. You've got your crypto, Bitcoin pumping in price. Physical real estate, whether it's in the US or Australia, all-time record highs. Bonds are a relatively undervalued asset class, and in my opinion, for the strategies that I'm managing, and again, not investment advice for you, I'm just letting you know what I'm doing, it makes sense to have some allocation to bonds. For me and my clients, that's 10% allocation to US bonds, roughly. Obviously, it's hard to get it exactly 10%. Japan is having a bit of a debt collapse at the moment, and we're on a weekly chart there, but if we look at a 1-year chart. So the highs in March, the levels are holding for now. And you can see negative divergence. Again, on the momentum indicators, negative divergence. So we've had a big run up and we're starting to hit a bit of a top here. Now, again, I acknowledge that it can break out, but we've had a good run. So keep in mind, this is bond prices falling. So if interest rates are doubling, that doesn't mean bond prices are down 50%. I'd have to get a bond calculator and figure that out. It depends on when you bought the bond and how long till it matures. But that would obviously indicate that the price of Japanese 10-year government bonds has gone down significantly. So they've had a significant sell-off as stock markets around the world have recovered, as Bitcoins hit 110,000, et cetera, et cetera. So just from a risk management perspective, don't get too caught up on one thesis. It does make sense for me and my clients to sell a little bit of the things that have gone up and make sure we have some allocation to the things that are relatively undervalued. Now, Australia is moving on to Australia. Let's have a look at 10-year debt. Australian bonds are not, I think it's more clear that they've topped out. You can see, the top came again in 2023. This is the 10-year Australian government bond. Very similar chart again, rising rates. The breakdown, the return to the scene of the crime to test, which was a new high, but you can see the negative divergence on the momentum indicators, running out of momentum, indicating that interest rates have topped. And you can see this is a 1-year chart of 10-year Australian government debt. A little bit messy, this chart, but you can see the trend is it's a little bit hard to define. You could say there's support there, but if there's a debt collapse, what a debt collapse would look like, if the debt was collapsing, it would be doing this. The interest rate would be skyrocketing. Does that look like, now let me just reset that chart. Does that look like we're in a debt collapse when, the debt is, let's zoom back. It's going to look a bit messy. Wonder how far back we can go. The interest rate on a 10-year Australian government bond today on the 7th of June, I can't quite get the exact date there, is the same as it was in June 3 years ago. So if there's a debt collapse, why is the price completely flat over the last 3 years? The debt collapse has, in my opinion, most likely already happened. If we go to 20-year Australian government bond, again, sideways, look at how many times it keeps this 5% level. It seems that for Australia and for the US, the 5% rate is about all that that governments or the market can tolerate. Have a look at how many times we're topping out at 5%. And of course, the 30-year rate, same thing, 5.2%, a little bit higher on the 30-year rate. But even if I drew the line at, say, 5%, you would say anytime we're getting above this line, and let's zoom back and have a look at 5 years. We've got the 5% level there. Again, doesn't that look like we're losing? We had the debt collapse, and now we're losing momentum. Yes, it's still grinding up a little bit, but have a look at, it's compressing. It's not, where's the strength of trend? If we're in a debt collapse, it's going like that. So that one doesn't look as bearish, this chart. It does look like it wants to maybe push a little bit higher. Maybe we are going to get up to 5.5% on the 30-year. Let's have a quick look at, just in the interest of time, let's rush through it and let's have a quick look at some of the other nations and just see, because if it's a debt collapse, if it's a global debt collapse, as the gurus are telling you, how come the Greek government can borrow money for 3.3% for 10 years? Again, we're looking at a weekly chart here. That was August 2021. You can see the Greek government was paying, well, it was only paying 0.56% to borrow money for 10 years. Of course, that's because central banks were printing money, or, doing asset purchase programs to buy these bonds. That's why. And then, of course, inflation hit, so they had to stop doing that. And there's your debt collapse. And it peaked in October 2022. And that's probably partly because the European Central Bank has cut interest rates 10 times. So even that short-term rate is going to have some kind of drag, or pull down longer-term rates a little bit. And you can see that. Have a look at the interest rate on Greek government debt since October 2022. What does that look like? It's been in a downtrend for 3 years now, trending down, trending down. Keep in mind, that means the opposite of a debt collapse. That means the price of debt is going up. This is the price of debt going up. This is the price of debt going down. This is the debt collapse, and this is the undebt collapse. Let's have a look at the French. Looks a little bit worse, but again, same price there. So that's what the 10-year bond is. It's the same as it was, or maybe just a touch higher than the peak in October 2022. Italy, same thing as Greece. Have a look at where 10-year interest rates are on Italian government debt, same as they were in May of 2022. Again, where's the debt collapse? We had the debt collapse. Germany, same thing. They're only paying 2.5%. Does that sound like a debt collapse? So I'm trying to reconcile what the gurus are saying, because on one hand, they're saying central banks have lost control. They're saying the European Central Bank, the Federal Reserve, the Reserve Bank of Australia, whatever it is, the Japanese, the Bank of Japan, that they've lost control of the debt markets and we're in a debt collapse. Okay, well, that means, and I listened to George Gammon this morning, he's talked about it a lot, how the Federal Reserve doesn't control these rates, the market controls. Okay, so if the market controls them, the market is loaning the German government money for 10 years at 2.5% interest. Does that sound like a debt collapse? If we're in a debt collapse and the market controls interest rates, apparently, then how is the German government able to borrow money and pay a tiny amount of interest, 2.5% interest? Does that sound like we're in a debt collapse? You be the judge. If we were in a debt collapse, people would be terrified to loan governments money, and they would be having to pay 20, 30, 40% interest to borrow money. 2.5% doesn't sound like we're in a debt collapse. Italy, again, another bank. I don't know what that spike is on the chart. That's an anomaly. I wouldn't go off that. But again, 2.84%, same level as it was back then. Spain, same thing. So I'll rush through these. And then the UK is looking a little bit worse. They're in a bit more trouble. And they're having to pay 5.34%. Okay, so that looks a little bit worse, but again, it looks like this is like the debt collapse has happened, and now the debt collapse is just kind of slowing down a bit. Although I'd say the UK looks the worst of those European nations I've gone through. So I hope that gives you a little bit of a picture of where these debt markets are at. And, for me, I want to buy low and sell high. And, I'm looking at this, and I understand why these gurus online are calling for a debt collapse, but for reasons beyond what we can talk about in this simple charting video, if we're in a debt collapse, that means, like, for example, the US. Let me just go to very quickly to US debt clock. Now, the US is approaching 37 trillion in debt. They are spending an additional, they're borrowing about $2 trillion a year, but that's the official budget deficit. The debt goes up more than that. They spend, 40% of 40% of spending, well, they spend 40% more than they collect in tax revenue. All right, so the largest items in the budget, if we're in a debt collapse and they can't keep borrowing money, that means massive cuts, not in the future, massive cuts today to Medicare and Medicaid. So to the government healthcare system. People think America doesn't have government healthcare. They do. It's their largest spending item. They spend $1.683 trillion US per year. So they spend way more than the entire Australian federal government spending on everything, on Medicare and Medicaid, Social Security, that's retirement, age pensions, right? Good luck cutting that. You're going to tell retired people that they're not going to get their age pension or they're going to have to take a 20% haircut because that's what happens if we're in a debt collapse. Of course, we don't have to be in a debt collapse because anytime we want, sorry, not that this is a good thing, but anytime the Federal Reserve wants, the Federal Reserve can invent dollars in their computer and they can buy these bonds and they can push up the price of TLT and other bond funds. They can push the price up like they did during the pandemic, like they did in 2008, and they can push down the interest rate anytime that they want to. They're just not, they're choosing not to do it yet. But of course, as we looked at, and from Trump's post on Truth Social, he is, too late at the Fed is a disaster. So he's saying too late to cut rates. Europe's had 10 cuts, we've had none, despite him. So he's talking about Jerome Powell. Our country's going great, go for a full point. He wants a full percentage point rate cut. And at some point, I think he's going to get it. Anyway, that's probably a bit longer than I intended to go for. Hopefully it puts a few things into perspective. I really feel like the charts give us a picture of what's happening because you watch all these videos and people are talking about debt collapse. And if you just take a moment just to look at the charts in a very basic sort of way, you can visualize whether we're in a debt collapse or not. And I would say that the debt collapse has already happened. Maybe I'll be wrong and there'll be a second leg, a far more destructive leg. But hopefully I presented a case that the debt collapse ended probably in late 2022, but definitely by the end of 2023. Let's revisit in the future and see how wrong I got that. Enjoy the rest of your weekend. Cheers.